This Week in Economics on the 26th of September 2015. Numbers man here. We had some news out of Amherst, Massachusetts. The Chair Yellen of the Federal Reserve fell ill while actually making a speech. Was looked at in a room off stage. And evidently she was a bit dehydrated, and they were able to rehydrate her, I suppose, by just giving her some fluids. But nonetheless, she was able to continue, and she was back in Washington. Thus, the markets had nothing to get scared of due to anecdotal information. That usually is always the case with the markets. They tend to be extra jittery about nothing. We'll read the speech that she delivered in just a minute here, and then we'll have some other financial information here this week. Quite a bit of financial information out. And we'll look to it and see exactly where we are here. The Chinese premier was in Washington. He was overshadowed by the Pope, but nonetheless he was there. And I was just looking at the Bloomberg news here. Nothing exciting here as far as Bloomberg is concerned. So things are, as they say, moving along a bit normal. Just see if we have some of the market releases out here. They provide some of our P&I explanations here, and we'll see exactly where they fall. There is some new information out from the market organization in their PMIs. We have quite a few of those out here. We'll get a selection we have from the U.S. and from Japan. We have the service, and we'll just go ahead and do the manufacturing from the U.S., and then we'll do the Eurozone. Well, first we'll do the Chinese. This was out on the 23rd of September. But it is current basically here. We almost got the one in Mandarin, but we'll get the one here. Nonetheless, the PMI is at 47 in September. It was 47.3 in August. This is a 78-month low. And the Flash General Manufacturing Output Index at 45.7 in September. It was 46.4 in August, another 78-month low there. So the summary here is the PMI decreased fast rate, output decreased fast rate, new orders decreased faster rate. That should be faster. New export orders decreased faster rate, employment decreased faster rate, backlog of work increase slower rate, output prices decrease faster rate, input prices decrease faster rate, stocks of purchases decrease slower rate, stocks of finished goods increase faster rate, and quality of purchases decrease slower rate. Suppliers delivery time lengthened from no change there. So this is what we get from a market for China. Not a lot of information here as far as the Chinese market, but nonetheless you get the general idea that things were not, as they say, as rosy as you perhaps would expect. But nonetheless, we'll move on from China, and we'll move to Germany's PMI and grab it while we are here. Let's see. The Flash PMI Composite Output Index is at 54.3. It was 55 in August. It's a 2-month low there. The Flash Germany's service activity index at 54.3. It was 54.9 in August, a 2-month low there, and the German manufacturing PMI is at 52.5. It was 53.3 in August, another 2-month low. And the flash Germany manufacturing output index at 54.2, and it was 55.1 in August, another 2-month low there. And let's get some common summary. The German private sector companies reported further growth of output at the end of the third quarter, Q3. The pace of expansion slowed slightly since August, but remains above the long-run series average. This was highlighted by the seasonally adjusted market flash Germany composite output index, falling from 55 to 54.3. Needlessly, the average reading for Q3 as a whole was the best over a calendar quarter since Q3 of 2014. Manufacturers and service providers both reported a slightly weaker growth of output despite a marginally weaker rise in private sector activity. Companies signal accelerated growth of new business in September. The rate of increase was the most marked since November 2013. Let me get up here and do a little adjustment here. Panelists commenting on the positive economic environment, improved demand for both domestic and foreign market manufacturers reported a second consecutive monthly rise in new export orders. Following the trend that started nearly 2 years ago, the private sector in Germany rose in September. Moreover, the rate of job creation accelerated fractionally since August and was strongest since December of 2011. Survey participants generally linked increased workforce numbers to higher business requirements. Now, Germany has also taken on a lot of immigrants recently here that will solve some of its age problem. And we'll get into a Volkswagen in a minute here and some comments there on the German quote-unquote business outlook. Meanwhile, business outstanding rose for the second month running in September. The rate at which backlog work accumulated was the most marked in 52 months. According to anecdotal evidence, increased new orders and capacity pressures accounted for much of the latest rise in outstanding work. Inflationary pressures eased slightly in September, with input and output prices both rising at weaker rates. Input costs rose only marginally, with goods producers signaling the steepest drop in input prices since January. Manufacturers attribute the decline to lower prices for energy, oil, and some raw materials. Again, commodities. Meanwhile, the service providers reported a further increase in input costs. German manufacturing companies remain cautious about their stock policies in September, with both pre- and post-production inventories declining further. Meanwhile, suppliers' delivery time continued to lengthen and abide only marginally. Service sector companies report optimism towards the 12-month outlook for activity in September. However, the level of positive sentiment fell from August's 4-month high. So that is basically that. And a comment here by Oliver Kolinsky. He's an economist at Market. The German private sector companies remain in expansion mode at the end of Q3 as they highlighted by further increase in output. Despite slowing slightly since August, the rate of growth was healthy overall and indicative of further rise in gross domestic product in Q3. Digging a bit deeper into the data suggests that the German economy is set to grow But in the coming months, new orders rose at the strongest rate in almost 2 years, with companies benefiting from positive economic environment, improved demand from both domestic and foreign clients. Moreover, the German job agency keeps humming as companies add to their payroll at a rate not seen since December of 2011. The fact that backlogs of work accumulated at the most marked rate for well over 4 years adds further to signs that companies will remain busy. Lower energy costs, meanwhile, extended downward pressure on cost inflation, with input prices rising only fractionally. The data therefore suggests that consumer price inflation will remain low, at least in the short term. Now, that is actually what you want to happen. Let me move to the U.S. manufacturers PMI. This, I believe, was on September 23rd. Nonetheless, PMI unchanged from August's 22-month low. These are some of the key points. Output growth picked up slightly in September. September data highlights another month of relatively subdued growth, but momentum across the U.S. manufacturing sector. The PMI, manufacturing PMI, registered 53. 50 is the break point, unchanged from August's 22-month low, to signal one of the slowest rates of manufacturing sector expansion in the last 2 years. The latest index reading was also weaker than the post-financial crisis average of 54.3, although output rose at a slightly faster pace. In September, soft rates for new business and employment growth placed downward pressure on headline PMI ratings. The latest increase in new work was the weakest since January of 2014. New export orders picked up only marginally in September, despite widespread reports that strong dollar had weighed on demand from abroad. Although only slightly, the latest rise was the most marked since February. Weaker overall new order growth and heightened uncertainty regarding global financial outlook encouraged inventory streamlining and more cautious job hiring across manufacturing. The latest increase in payroll number was only marginal and the weakest since July of 2014. Stock of finished goods, meanwhile, decreased for the second month running, and the rate of contraction was fastest since June of 2014. Pre-production inventories rose at the slowest pace over the year. In September, which manufacturers to subdue business conditions. Average cost burdens decreased in September, therefore ending a 4-month period of rising input prices. Seen the same thing happening in Germany. Manufacturers cite lower prices, range of raw materials, particularly metals, along with a decreased oil-related costs. Meanwhile, factory gate charges dropped for the first time since August of 2012. Anecdotal evidence from survey respondents suggested falling commodity prices, intense competition, competitive pressures, and soft demand conditions were all factors contributing to discounting in September. A comment from Dr. Williamson. He's the chief economist at Market. Manufacturing remains stuck in a crawl gear in September, fighting an uphill battle against a strong dollar, slumping demand in many export markets, reduced capital spending, especially in the energy sector. And we've seen that over the past several months. Let me get to the rest of Dr. Williamson's comments here. The survey indicates the weakest manufacturing growth for almost 2 years, meaning the sector will act as a drag on the economy in Q3. Disappointing performance of goods-producing sectors have been so far offset by strong expansion in the larger service sector, which means the economy looks to grow at a reasonable 2.5 amortized pace in Q3, but